Now let's take a look into some of our subscriber requests, and then we'll take a brief look into my portfolio. So not going to be spending too much time on these, but we have a first request here from Ehsan, and he has asked, can we do ADMA and TRMD? No problem at all. So let's take a look at ADMA. So ADMA, it's ADMA Biologics, right? So this is a company who does, they are in the business, though they're a biotech company, right? They're in the immunology company, in the immunology department of biotech, right? So as a whole, I'll tell you this, Ehsan, and I told one of our other members as well when we did some of these biotech stocks in the past, these are not my specialty as a whole, right? So it's not that I don't understand them, it's that there's a lot of professional expertise that goes into analysis on these companies, right? Because a lot of their revenue is beholden to two things. Number one, patient trials. And then number two, if those patient trials go well, then they have to submit approvals for their drugs to the FDA, and then the FDA gives them approval whether or not they can move forward with their drug administrations or their vaccine administrations towards more patient trials, right? So in terms of this one, biotech company, and they are on the upswing right now. So this is a company that was never profitable in the past, and now they're finally turning the corner to profitability as a whole, and we can see that best in terms of their EPS. So take a look here, guys. They're now turning the corner, now going to positive EPS, and also very nice revenue expansion as well. In terms of price to sales, since this company is not positive, we can't really do price to earnings ratio, so you have to go price to sales. They have a market cap of about 1.3 billion. And their revenue for the given year is expected to be about $300 million. So that's about a 4-to-1, 5-to-1 price to sales. Not the worst for a biotech company, I'll have to agree with you. And it's nice to see that they will be turning the corner to profitability eventually, which is a big problem that a lot of these companies have. Now, my advice for anybody looking to play these biotech companies is you have to understand the fundamental theory or the fundamental thesis. What is the bull thesis for the company, right? So what I would do is research. You have 4 analysts that have strong buys for the company. What I would do is I would Google who are these analysts and what are their bull case theses for the company, right? It requires for us to do individual analysis on this. It's kind of out of my scope of expertise, guys. I don't understand these companies very well in terms of the drug patents, right? And the stages of approval that they have to go through. So in terms of fundamentals, guys, it's a bit of a gray zone for me, I will admit. But in terms of the technicals do look good. The fundamentals are improving for the business. But once again, we have to know, are there any pending drug approvals, any pending vaccine approvals that need FDA approvals to really launch this business into the future? Because if these EPS projections, right, if some of these EPS projections are based off of the fact that they're pending a vaccine approval from the FDA and they don't get it, well, then obviously all of these projections have to be revised to the downside. And that would obviously not be good for the company, right? So very, very cyclical business indeed as a whole, right? So it's really reliant on a lot of those approvals to move forward or move backwards. So in the context of a beautiful monthly uptrend right now, just looking for the monthly higher low, keep an eye on these levels right here, guys. This is going to be the big level they're trying to retest right now. We're talking roughly between 530 and about 475. This whole pocket right here is going to be that area for the monthly retest. If it's a company that you're bullish on, if you know a lot about it, if you're in the medical field and you understand this company a lot and you find it's a good opportunity, I would be looking for it down here just in terms of a technical basis, because on the technicals, it does look very, very good, right? So just keep an eye on all those things, for consideration. Really important to do your analysis on this company. If you are only playing this company for the potential of gains, right? Because you see a 2x in the company or something like that, I do believe that there are better plays to make 2x's than on biotech companies if you don't understand them. If you understand them and it's your bread and butter, by all means, go for it, guys. But if you don't understand them and if you're only lured into them for the potential of a quick 2x, the biotech industry has made a lot of people a lot of money, but it's made a lot more people lose everything. So just keep that in mind, guys. It's a very, very, very volatile sector. Sometimes I play it under ticker XBI. This is the Biotech ETF as a whole. And when healthcare really gets into its rally mode, which is it's getting into now. It's the early phase of a healthcare bull market. This still has not rallied a lot. So I will be looking. There is one play here for me on biotechs as a whole, but I will not be using XBI. I'll be going a little bit more, let's call it degenerate on it, right? I'll probably be using LABU. This is the 3 times leveraged biotech industry. And you can see they've been selling off. So I'll be looking maybe to build a position in biotech if the trade is on the table. That is pretty much everything that I had to say about ADMA. Ehsan, I'm very sorry that I can't be more helpful with this one. It's just not my area of expertise, but the fundamentals seem to be improving. The technicals look very gorgeous as well. I would just want to have a deeper understanding of what is the bull thesis behind this company. Is the revenue growth consistent and stable, or are they potentially waiting on some vaccine approvals by the FDA that could unravel the entire thesis as a whole? That's what I would take a look at for that one. And for the other one, guys, let's take a look at TRMD. So he said that Howard Marks earned this one, guys. So if you don't know Howard Marks, guys, very, very legendary investor indeed. He was the co-founder of Oak Tree Financial, billionaire at this point, made most of his money back in the 80s and 90s. He was, Howard Marks is a person that, as opposed to certain investors like Warren Buffett's, he does take asymmetric bets, meaning he will go for riskier bets in cyclical industries sometimes in search of higher return probabilities. So he does do a lot of your more volatile trades in terms of that, a lot of your more not necessarily dangerous trades, guys, but just out of favor trades as a whole. And he's made a lot of money in the process. Very, very strong investor as a whole. So TRMD, apparently Howard Marks owns TRMD. My apologies for this. And TRMD, I saw this one pretty much in the course of last year. Now, what does this company do? They are a marine shipping company, guys. And if you know anything about Howard Marks, is that he takes these speculative bets down here. He does not take these speculative bets up here, right? So this is a cyclical bet on inflation, right? This was a trade that was a very prevalent trade in the early stages of 2022 when inflation was really skyrocketing and supply chains were disrupted. Obviously, the cost of shipping when supply chains are disrupting goes through the roof. You can see that best with companies like Zim, right? Zim had a tremendous rally here in the early stages of 2022 before pretty much collapsing. They obviously heavily beholden to the whole shipping market. Another company like one of your larger company, right? Like this is going to be one of your the largest player in marine transportation as a whole, Maersk, right? Everybody probably knows that brand. Look, these guys did excessively good in the late 2021, 2022 era, but have since been coming down as a lot of those supply chain constraints have alleviated, right? So this trade is in this TRMD is in that very late cycle trade as well, guys. This is probably not the time, not financial advice, of course, but this is probably not the time to be starting a position, right? If we take a look at some of your fundamentals, you will understand why. I know obviously they pay a 16% dividend. These shipping companies are known for that, right? It's very tough for them to reinvest their capital and expand their business. Usually, all of these companies, the marine transportation business is a very, very tricky business, right? All right. So a lot of these supply routes are controlled either by government entities or by larger players, and they tariff and fee these zones left and right. So it's very tough for a relatively small company like these guys right here with a $3 billion market cap to compete with one of the largest players in the game who are at market caps of about $170 billion. It's a very brown envelope business, guys. A lot of shady business deals go down in your whole shipping, the shipping business as a whole. All right. So let's just leave it at that. But all in all to say, guys, this trade is at the last end of its legs, in my opinion. And you can see it best when you take a look at the company's fundamentals, right? Take a look at the fundamentals here, guys, right? Company doing absolutely nothing, inconsistent earnings. And this is the same with a lot of shipping companies when they're smaller shipping companies, right? And they don't have an almost somewhat monopoly on your marine transportation routes, your shipping routes. What happens is your earnings tend to be extremely inconsistent. And this was the case as well. But they did get a tremendous bump in their earnings in 2022 and 2023. Was it because they expanded their business? No, it was because they were able to charge 5, 6, 7 times the normal price of a shipping container to anybody who needed one. That's where a large part of their earnings came from. And you can see 2024 is the last year in which these price increases will hold true. And thereafter, what happens to their earnings per share? Well, steadily starts declining back again, right? So fundamentals for the business, inconsistent. This is the last year of EPS growth, and then it'll start falling apart. Take a look at your revenue inconsistency as well. Inconsistent revenue explosion, and now that your supply chains are being reestablished, well, this company is now going to lose revenue as well. And expect this as well, guys. If your Middle East tensions alleviate, so if the tensions stop, Red Sea, Israel, Hamas, Iran, if those tensions all stop, well, obviously, guys, the shipping prices are going to come down, and this company is not going to do as well. This company is heavily reliant on the disruption of the supply chains, and right, so just not the wind is not at their back currently, right? The wind is currently in the back of the trade, saying that supply chains will ease and geopolitical tensions will ease as well. So unfortunately, this is not one of my favorite plays as well. I understand completely why Howard Marks made this trade probably back here, and it was a very good trade for him. But at this point, guys, this is the take profit territory. I would not be in this trade personally. And for anybody who is in this trade, right, just keep an eye, guys, right? Your price targets from analysts are up here. This could be the last momentum for this stock before potential continued cyclical decline back to the industry average. So keep an eye on that company as a whole. So hopefully that was insightful. I don't mean to dissuade this investment idea. I just wanted to give a little bit of more of a context of why this trade happened, why someone like Howard Marks would have taken an asymmetrical bet like this back then, and why it played out beautifully for him most likely back in the day, and why maybe he's still potentially holding on to some of his position, probably until maybe the later part of 2024 when he may just close that position and pivot into another cyclical trade. Now, that's pretty much everything for your subscriber request. Now let's take a very quick look into my portfolio, guys. Apologize for the length of the video. All right, guys, so taking a look at the portfolio here, you can see that we've pretty much stalled on all the gains since the midpoint of the month of March, which is kind of similar, exactly what SPY and QQQ have been doing as well, right? Not really doing much since the midpoint of the month of March, and QQQ not doing much in terms of the midpoint of the month of March. That's just been because we've been assigned a few positions here, guys, a few that I've maintained since last Q4, namely Alibaba and Nike stock, which have just kind of continued to slowly decline. And we also got assigned 200 shares of Apple, right, over the course of the month of March, and Apple hasn't been performing the best, but we are now above our break-even price. So the portfolio, we've been generating premium. All the while, our assigned positions have been coming down and down and down. We're continuing to write premium. So we're continuing to build up a good little cash cushion here. It's just unfortunate that we haven't been able to get much lift on the portfolio so far this year. Underperforming the SPY, underperforming the QQQ, guys, but I'm going to make a bet with everybody that we are going to outperform the market significantly by the end of the year. That is for sure, guys. I'm very, very, very confident in this whole market as a whole, and the outperformance should come just a little bit later than expected. What really held us back was being assigned those stocks early on over the course of the year, namely Nike, Starbucks, Alibaba, which really came down hard here early on in the year. We were able to get out of a few of those positions, and cut the gains or cut a few losses as well. I cut my CSIQ solar position as well. But all in all, it's been a very good year in terms of portfolio recovery. I'm very satisfied. It's just unfortunate that I can't show you guys more gains. I would love to, but I've been playing these markets fairly conservative. And you guys have noticed, right, how conservative I've been pretty much since the month of March, not getting too aggressive with things. And that will continue throughout the month of April as well. I'll be very conservative, but once we get through this period, I will be going a lot more aggressive and we will be juicing up the portfolio. So now moving on to the positions, guys, you can see that. Let's start it off with some Apple. So Apple, after having a tremendous rise over the course of last week, well, it was obviously a very good time to sell some covered calls. So my break even at that point on Apple was about 176.35, right in this range right here. And when we got above here, Apple had been green on a day where the entire market was red. And then on the day, we had geopolitical concerns that Iran may launch a missile strike over the course of the weekend. So you guys know me, I was like, well, Nope, no thanks, not willing to take the risk. So I wrote some covered calls when the market was up here, and I got heftily rewarded for them. Take a look at this, guys. We wrote the 175 calls. At the time, the market was in the 176 range, and I wrote under my assigned strike price, under my break even, which was about 176.40, 176.30 up here, right? We got $3.50. The reason I went with the 175, guys, is I was sure that if geopolitical concerns were going to be an issue over the weekend and today, that Apple stock was going to drop, and I wanted to get the most premium possible. That's why I didn't write above at the 177 or even the 180s. I wrote the 175s because it provides cushion to the downside, and you can see that even better. We wrote these on Friday for $3.50, and they're already down to $1.12. So we've been able to pocket all this premium, and it brought my average cost to Apple now down to about $173.36. So looking fairly decent on Apple. I will continue to do covered calls on this position. Now that our average cost is fairly low, I'll be able to run covered calls anywhere between 175, 172.50 moving forward, just trying to reduce this average cost as much as possible, all while Apple is going to be in consolidation. So looking forward to that. We obviously got assigned 200 shares. This is some Intel covered calls. So last week we did get assigned 200 shares of Intel. We got assigned 100 shares at 37 and 100 shares at 39. Now we did get some premium as well from those two contracts, a total of roughly 50 cents. So our real break even on Intel right now is about $37.50. I apologize, I didn't put it on the screen, but that is right about here. So what we did today with the position is we chose to write some covered calls around our break-even cost, because Intel, even though it was green here today, guys, if market conditions don't improve and the markets remain red, well, there's no sense in us trying to get more premium up here, right? We may just write fairly conservative, and if the markets do just consolidate sideways or slightly down, we'll just continue to collect juicy premium and reduce our average cost basis even further as we get further and further into this big zone of consolidation, which really comes down all the way to about $33, $34. All in all, guys, I'm fairly happy with the premium received. We got about 21 cents for them. It's good that I was able to write covered calls on a day where the whole market was down. So this is over our 0.5% rule. That's going to really bring our average cost on Intel down to about $37.30, which is not that bad. So we'll continue doing this as well. In terms of Expedia, we're still having our assigned position on Expedia. You can see that right here. We have 100 shares of Expedia, and our break-even cost on that Expedia trade right now, after those covered calls, you can see all premium received here on the left. Our average cost on Expedia now is down to about $129.74. So Expedia is still looking good. I do believe that the likely area of support is coming up on us quickly. Is that going to be 126 down to about 120? That's going to be our area of drawdown that I'm expecting for Expedia. Still looking very good. Monthly uptrend, looking for the monthly higher low. Good moving average support down here. And the company's fundamentals are obviously very bullish too. But overall market conditions did drag this one down as well. So as long as we do remain here, if I am able to pocket, you can see I wrote the 133 calls for this Friday. They're only about 40 cents left in those. So I may roll them down to like the 131s. I'm really not expecting stocks this week to have a tremendous V-shaped rally of any kinds. So if ever, guys, we just end up flat tomorrow, I may even roll these 133s, maybe down to 132, 131 even, as long as it's above my break even of 129.74. I'm just looking to collect as much premium. You can see there's not much premium left in these. So if I roll down to the 132s or the 131s for Friday, maybe I can get more premium. Maybe I can get 60 cents, 80 cents, right? All of that extra premium will just contribute to bringing my average cost lower and lower, so that eventually when we do bounce, we can start getting some very, very juicy gains on a lot of these positions. Now, we did get assigned. We're not assigned yet, but JP Morgan, I took a chance on JP Morgan. This is why I tell you guys not to play earnings, right? I did a put contract on JP Morgan at 185 prior to the earnings. The volatility was supposed to give about a move of 3% up or 3% down. I went with almost twice the expected move. I was about 5.5% away, and it wasn't enough. JP Morgan reported very beautiful earnings, but geopolitical tensions brought this stock down hard. So you can see now that we're under my potential assignment point right down here at about 185. Am I nervous? No. JP Morgan is an extremely high conviction stock for me. And the lowest, in my opinion, that we can ever get is probably going to be around that 172 mark. So I will most likely be holding this position. Yes, it's unfortunate that we have to potentially take assignment of JP Morgan, but I should be able to write some covered calls on this position. So we'll see how this evolves over the course of the week. I've not written this one off completely. JP Morgan could have a little bit of recovery here. It was over 185 in the morning. we'll see how this one plays out. But the larger area of support, guys, is down towards the 175 range. The company is so healthy, guys. Really not nervous of being assigned this one, but this just goes to show the dangers of playing earnings when a company reports earnings that are very good and the market just takes them the other way. Sprinkle in a little bit of Israel, Iran volatility, and you have a potential earnings play that just goes wrong. So now then as well, we have Shopify. We got assigned a lot of things last week, as a matter of fact. Shopify 72s. We had the Shopify 72s. We got assigned, and our Shopify, we're now writing these $72 calls on Shopify. So my average cost on Shopify right now is going to be roughly $71.60. I apologize for not putting it on the chart, but that's going to be right about here. All right. So I was able to write some covered calls. Shopify is coming up into this area. I'll remind you why we're taking this trade. Monthly uptrend looking for the breakout. Retested this range. Monthly good support level is right here. Monthly control is well underway by the bulls right now. No red flags in terms of our longer term trades, but Shopify obviously not immune to the negativity we've been having in markets as of recently. Has anything changed with the company specifically? No, it's just the overall context of the market, right? So we benefited from today's price action to write some covered calls. You can see we got for the 72 calls, which is my assigned strike, we got 51 cents for them. So now my break even on Shopify is getting very close to $71 here, guys. So I will continue to write covered calls on Shopify this entire time that we come down below. That's why I didn't go too heavy on it. There may be an average down opportunity. If we come down into the lower $60 range, I may be looking to throw an average down into the position in the lower $60 range. I'm very bullish on the company, guys. Understand why you play a company, right? Because of the valuation, because this company is currently underway in a turnaround story, regain profitability and cut a lot of costs in the process. So I'm relatively happy with my level on Shopify. We'll continue to average down into the position by writing more premium against it. Now, a couple other positions that we do maintain. We still have the Amazon call. I'm on the fence whether or not I should close this one, guys, to be honest with you, because of current market conditions. The only thing preventing me from closing this one right now is I truly believe that Amazon will have outstanding earnings as a whole. However, the one thing that we may face if Amazon has outstanding earnings, but if we sell off prior to earnings and then earnings is good, it may just take us up to right where we were right now, right? So Amazon, I'm still willing to hold this one through the earnings cycle. This went as high as about $45. I could have pocketed, $700-800 in gains, but I'm holding this one. It is a leap call contract, so I'm holding firm. If anything, guys, I most likely will average down. We'll see how markets develop. I don't really want to take this one off the table, but we'll see. Maybe if I come to that consensus tomorrow or Wednesday, potentially if there's another play that interests me more and I want to reallocate this capital in anticipation of Amazon earnings, we'll see. So far, I'm leaning 75% hold, 25% cut the position and maybe re-enter at a later date. So that's pretty much it. If not, we still have our same swing trades, MELI, SPGI, and the rest of the stocks we've covered. Nike, not high enough for covered calls yet, and obviously not low enough to average down into. I would like to see Nike below 90 to be able to average down. BABA, not high enough for covered calls. Could be a consideration for puts over the course of this week. I might be looking for the 68, 67 puts if we get a big red day tomorrow as well. So that's going to be looking to generate even more premium. Our average cost on Alibaba now is down to like $76. Very juicy. And the rest we've pretty much covered already, right? Apple, Intel, my Canadian banking shares still just chilling roughly $1 in profit right now. So that's pretty much everything for your earnings recap. Hopefully that was insightful for everybody. If you guys enjoyed the video, I really apologize for these long videos, guys. But I understand a lot of people are concerned. Maybe a lot of people are a bit fearful of the markets right now. So that's why I should explain what's been happening over the weekend. I promise you the rest of this week's videos, I will really try to keep them under 40 minutes, even if we do have some earnings to include in those as well. So hopefully all of that is educational for you guys. If you like the video, consider dropping a like, consider subscribing to the channel if you're new as well. We would love to have you here. And lastly, guys, if you have any questions at all, please leave them down below in the comments. Anything you want me to look at a specific stock, technical analysis on something, on options trade you're considering, anything you want, leave it down below in the comments and I'll be happy to answer within the first 24 hours. Take care. I'll see you guys tomorrow after the close. Peace.